Welcome back. Let's talk about a couple of other names then. Dipan Mehta, Director, Elixir Equities, joins us on the show. Hi, Dipan. Good morning. Good to see you. Let's talk about a couple of earnings reactions. Coal India, they've got valuation comfort. The volumes are not coming about, but at least your receivables have come down and the operational performance look quite good. So any comment out there? Do you like the stock? And Dabur, well, the numbers were weak, but as Mangalam said, they were expected to be weak. Your take?
Yeah, Nigel, good morning and thank you for having me on your show. I think a decent set of numbers from Coal India. Last 3-4 years, the performance certainly has improved. Efficiencies have looked up. They've been able to curtail their labor costs as well. And they're getting higher yields also from the open market sales. But look, it's a mature business and volumes will always be growing at single digit thereabout. But if you want a steady, safe stock, then certainly Coal India, kind of fits that criteria. So I'd remain invested, but from a fresh investment perspective, maybe go for more exciting high growth stocks. Coming to Dabur India, I think all FMCG, traditional FMCG are all avoid at this point of time. And although they are betting that a good monsoon and overall revival in consumer spending will improve their volumes. And if that does happen, it's a great opportunity to get out of all of these stocks. I think a lot of the categories have reached mature levels and the growth has been certainly the long-term secular growth of this sector now is in low single digits. So they're about in line with population growth and not in line with GDP growth anymore.
But we've had a bunch of the AC and cooler companies report numbers. Blue Star, Volta, Symphony's numbers look very, very good. Blue Star, at least for the AC business, the growth is a little lower than the street expectations. What do you think of all these three stocks? Do you like any?
Yeah, Surbhi, I think from a valuation perspective, again, disclosure, we and our clients are invested. I think Symphony offers the best risk-return profile and very impressive numbers. I think even Voltas and Blue Star came with good set of numbers, but they are fairly valued. At least Symphony, there's scope for P's to move higher considering the kind of growth rates. And a lot of the problems are behind them in terms of receivables and the slow performance of their subsidiary companies. But look, there was a line of warning coming in from Symphony that this particular showers which are taking place, that certainly is going to impact the performance, at least in the short term. But these are great long-term secular growth stories. All of these cooling companies, air conditioning, air coolers are no longer kind of a luxury. They are a necessity. And I'm very convinced of the long-term prospects of the entire industry.
Okay, all right.
With us, Dipan, just a quick word on pharma as a pack, if you have any thoughts, because that that executive order, Ekta telling us that FDA has now issued directions for more unannounced inspections, cost of inspections going up. I mean, sounded a little nasty. And what's your sense, Dipan?
See, in Prashant, in pharma, you have to try and go for the CDMO companies. And if you just see the result, I think OneSource, one of the new listings split from Strides, very impressive set of numbers came through over there. And that's true for Divi's Lab, also looking forward to great numbers from Suven in the longer term as well. So within the pharma space, that's where our focus on the CDMO companies. There's Blue Jet Health also. We discussed that company also in earlier shows. The general regular pharma company, the Dr. Reddy's, the Ciplas and Lupins, I think there's a cloud of uncertainty because of Trump tariffs as well. So I'd just like to be a little equal to underweight over there. And the opportunities are more in businesses which have a slightly differentiated business model.
Dipan, we spoke about Dawa. What about Daru? United Breweries, that's one of the top gainers in pre-open. The stock is up and about. It was getting very, very hot. Q1 could be better. Input costs as well have cooled off. Your take?
Yeah, I know, Nigel, but 125 times or thereabout trailing 12 months, how can you get great returns by buying at such expensive valuations? All I can say is that if you're invested in United Breweries, then remain invested. But from a fresh investment perspective, from these levels to expect a decent return, even outperforming the broad market indices, I'm not so sure.